What are the reasons that someone would want to sell out of the REIT?
Well,
What makes it?
now you're getting into the question of liquidity,
Yeah.
which is the big issue. So many people want to be in this real estate market and don't have any idea that they're stuck in these things. Well, a limited partnership, again, is just a group of people that get together, form a partnership. They have a general partner who runs it. All the investors are limited. The limited partners have all the money. The general partner has all the experience. After a number of years, when things go bad, the limited partners have all the experience. The general partner has all the money. Limited partnerships, where you have no control, and they're not liquid. Then we could talk about mortgage lending.
Yeah.
That's why we're here.
Welcome to the Capstone Convo. I'm Tyler Stone, founder and CEO of Capstone Financial and Capstone Fund 5. Today, we have Barry Zemel on the podcast with us. Barry is one of my oldest investors, somewhat of a mentor. We're just really happy to have you here. Barry, welcome to the show.
So glad to be here.
So first thing we want to talk about is how you got into alternate investing and kind of your investing career a little bit of history.
I'll
And
tell you my story.
yeah, what got you into alts?
So I'm previously a CPA, very boring books. Then I did a bunch of forensic accounting. What happened was in 1984, I was looking around at all these people who were investing in limited partnerships. That was the vogue back then in the early 80s. Everybody wanted to be in real estate. And the big brokerage companies were raising billions of dollars. And my partner and I looked at each other and said, I bet you there's some people out there that don't want to be in this anymore, and there's no place for them to get out. So we started making a market, a secondary market, and buying their limited partnerships. We opened up accounts at every single brokerage company, told every broker that we want to buy these limited partnerships. And when people want to sell at Payne Weber, Prudential, Dean Witter, Merrill Lynch, call us. And they came in and we started buying. We had no idea what we're doing. How do you value these things? Which my CPA background helped, because I was able to get through the financials and understand what the real value is versus what the brokers were telling them. And somebody would buy a participating interest for $5,000. We would probably buy it for $3,000. It may have been worth $4,500 or $4,000. So we were buying it at a discount and just holding them, waiting for an exit. And that's where it gets risky. Where is the exit? So we waited and we hoped that some of these buildings in these partnerships would sell and they would pay us off, or they would go public on an exchange and we would have stock and then just sell the stock. But that's how it started. And that's over 40 years ago, still going strong. That's what I do full time, is buy REITs. Limited partnerships are gone. Now we have public REIT, not public REITs, but private REITs that are publicly reported. They're very big, and we buy people out of those, and there's a never-ending stream of sellers.
Gotcha. So what are the reasons that someone would want to sell out of the REIT and they can't sell in the public market? Or
Well,
what makes it?
Now you're getting into the question of liquidity,
Yeah.
which is the big issue. So many people want to be in this real estate market and don't have any idea that they're stuck in these things because they were sold a bill of goods that it's going to appreciate. We'll get out of here in a few years. 3 to 5 years, we're out of here. That never happened. So it's a liquidity issue, or they have a life event. There's a death, divorce, pension plan is being terminated. They have to get rid of the assets. There's all kinds of reasons that people want to get out, and they find me.
Yeah.
In my niche, my secondary market niche, there's only a few of us in the country that are buyers. So I'm being found by brokers all over the country.
Why do you think that it's such a specialized niche that there's you and only a handful of others?
You have to know how to do it. You have to know who the brokers are. It's networking.
Yeah.
And then you have to assess the risk of how long you have to hold this and how long your capital has to be out.
Oh.
And that's the issue. You're buying this. It's very capital intensive.
Yeah.
If they're not paying a dividend, then you're just sitting there with idle cash out, and you have to assess when that exit is.
How many of these private REITs would you estimate pay a dividend versus don't?
For the REITs, I would say probably 60% pay a dividend at this point.
About 60.
Well, ever since the recession, and COVID, a lot of these big real estate deals, the office buildings and hotels, have really suffered
Yeah.
with their cash flow. And so dividends have really been diminished,
So
which means the price is now lower that I'll pay.
yeah, because the dividends is lower. Yeah.
Right.
Yeah, your ROI. You talked a little bit about, okay, back in the 80s, it was limited partnerships. Now it's REITs. What is to someone who's not familiar with either one, or to someone that's not very familiar with alts, what's the biggest difference in investing in these things back in the 80s versus now?
Well, a limited partnership, again, is just a group of people that get together, form a partnership. They have a general partner who runs it. And all the investors are limited. The limited partners have all the money. The general partner has all the experience. After a number of years, when things go bad, the limited partners have all the experience and general partner has all the money. Isn't that the old story?
Yeah. Okay, right.
We have done best by buying out limited partners in very small partnerships. A partnership that has perhaps 100 partners, and they all put in $100,000.
Yeah.
And they went out and bought a building
Yep.
years ago. And we come in years later when the original people who put in the 100,000, who are now dead because they were rich back then,
Right.
that could afford it, their beneficiaries have no idea. Hey, we own this piece of property. We own a partnership. What is it? We get a K1. We hate K1s.
Yeah.
They find us and we buy them out.
Gotcha.
So limited partnerships, their format, having K1s and having a limited life that's built into the operating agreement, basically lost favor. And the REITs took over.
Right.
The REITs are streamlined. It's a 1099. It's easy. They have to pay out 90% of their operating income, their free cash flow. So it was very attractive, more attractive than a limited partnership.
What's just for the non-ex-CPAs out there, what's the difference between K1 and 1099? And why is it why is it easier to have a 1099?
A 1099 is one piece of paper that basically says, this is how much you received in distributions. That's your income.
Gotcha.
A K1 shows you your income, your deductions, your interest carry. Whether or not you made a distribution, you might have income and have to pay tax on it, even without any cash.
Gotcha.
Phantom income.
Right. And a 1099 is not going to show that.
1099 only shows what you get.
I gotcha.
How much easier is that? And the K1s now can be 80 pages. I mean, they've made it so onerous.
One K1 for one investor can be 80 pages.
Oh, totally.
Oh, wow.
Totally. Because of foreign investments, anti-laundering, they threw in everything into the forms and they're outrageous. So when people get them, they hate it. And our best time to buy limited partnerships is in March and April after they get their K1s.
Yeah.
And people are so disgusted, they say, we don't even want to see this anymore.
Yeah. They're just frustrated.
We love it.
Heck. Yeah. Perfect. Note to self, keep Fund 5 K1 simple. Less than 80 pages.
You and I talked about that many years ago. Keep it simple.
Yep.
And that's what's being done.
Yeah. Yeah. Perfect. Barry, what would your definition of an alternative investment be as opposed to traditional investments that people buy, stocks, bonds, that kind of thing?
Right, with stocks and bonds, traditional. That's where everything was. 60-40, 60% in stocks, 40% in bonds. Very simple. Mutual funds then came in. The definition to me is risk and liquidity.
Risk and liquidity is the key.
Stocks and bonds, you can get out in a blink. It's liquid, almost like cash.
Yeah.
You start investing in real estate, it's not liquid. The risk may not be as much, but you start investing in other things, oil, coins, violins, which we did once, or even gold, it's not as liquid.
Yeah.
And then you have to assess the risk. Alternative investments, they pay higher, but they're riskier. And the risk comes mostly in the length of time you have to hold it with no use, no benefit on the cash that you put out.
Right. Like
So
some of these LPs.
well, that or even real estate.
Yeah.
I'm in real estate deals that I've been in 10 years with no cash flow. I didn't expect it, but these things happen.
Yeah.
So you have to assess what that risk is to your lifestyle, to your money needs.
Yeah.
You know, most prospectuses these days ask you your risk tolerance.
Right.
Most people just ignore that. Yeah, I could do that. But then when push comes to shove and they get divorced and have to split up their assets, what do I do?
Right.
How come I'm in this cockamamie thing?
Right.
So,
With an 80-page K1.
what did-
Yeah. How do I figure out the value of that? Right. Maybe give us some examples of some alternative investments that not violins, not coins. What would you think would be the top 3 or 4 categories or alternate investments people would hear about today?
well, the first one they hear about is real estate.
Uh,
That's the number one. For so many years, endowments and establishment organizations would not touch real estate. It was stocks and bonds because it wasn't liquid.
right.
Now everyone's in real estate. Everybody wants to be in real estate. So that's the number one quasi alternative investment. It's not really alternative anymore because it's become mainstream
Yeah.
through a lot of different mechanisms. Then you get down to the securities, which are REITs and limited partnerships, where you have no control
Mm-hmm.
and they're not liquid.
Right.
So that's really an
No
alternative.
control and not
Non-liquid.
liquid. Yeah.
Right. Then we could talk about mortgage lending.
Yeah.
That's why we're here.
Right.
In the middle, mortgage lending, like what Capstone does, is sort of liquid because they have enough product. It's a fund
Mm-hmm.
that you can get out, and it's always moving product.
Right.
Versus if you make a loan on one property, you have a risk that they go into foreclosure. You wind up with the property. So that risk increases. That's really an alternative investment.
Gotcha. So how would we talk about, okay, the risk in alternative investments, as we just talked about, might be being in an investment for an extended period of time without having use of that capital and also not having cash flow from that investment. So how would you weigh that risk against the volatility risk of the stock market in a traditional investment?
Well, stock market is totally liquid.
Yeah.
The normal markets.
Yes.
You're always dealing with the ups and downs of a market.
Right.
And if it's down, you could elect not to do anything. If you need the money, you get out. That risk it's not controlled by you. It's controlled by other factors, but you can define for yourself when you want to move on it.
Right.
So that risk is minimized because you can play with that factor of time.
Unless you have a life event or some need for capital, you can ride out the low.
Right. And you can borrow against it if you have
Yes.
stock. So if you need capital, you don't have to sell it at a loss. You can just borrow against it.
Right.
So there's mechanisms to get that liquidity.
Right. Gotcha. Okay.
Bonds are not as easy, but there's also a mechanism for getting those bonds into a cash position.
You can borrow against bonds as well.
That's absolutely.
Yeah. Gotcha. Okay. So Barry, we have we have some stuff in the newspapers now. Gold just hit an all-time high, that kind of thing. So what are some of the alt investments that get you excited right now or you think are notable in today's environment versus 10 years ago or 25 years ago, whatever?
Well, most of the things that are getting excitement today do not excite me because it makes me nervous.
Yeah.
There's a herd mentality.
Yeah.
Gold has gone crazy.
Yep.
Wonderful for people who had it. But at some point in time, that could change.
Right.
And then what do? I mean, there's no fluid market for it. If it drops precipitously, you're stuck.
Right.
You're
Maybe you can't borrow against it like a bond or something.
Yeah. Crypto, you have to understand it. But all of these things, I think, are more fad-related or being chased to increase their value without there being any intrinsic value in them.
Mm-hmm.
Crypto, for instance, it is just a reflection of what the market is, and the market could change.
Right.
I also invest a lot in venture capital,
Early stage companies type stuff.
Startup companies that are established, that are selling their stock, not on the market, pre-market, risky. And you have to, so that's another alternative investment that's very popular these days. Everybody wants to be in SpaceX.
Right.
You know, you can't just go in the marketplace and buy SpaceX. You have to find a place to get that.
Right. For those that don't know, SpaceX is not publicly traded like Tesla or whatever. Yeah.
And then all these AI companies that are not traded yet.
Yeah, these AI companies like Anthropic, yeah.
OpenAI, GPT. You know, everyone's chasing those. And my feeling is you have to be really cautious about chasing the latest fad.
Right.
So now that you bring up alternative investments, I'll talk about my most interesting alternative investments
Yes.
is investing in Broadway shows.
Broadway shows.
Very risky.
Yes.
You have no way to know what's going to happen, no matter how good the show is. I've had shows that I thought were fabulous. One show I invested in opened the same night as the producers on Broadway.
Ah.
The line for the producers, Mel Brooks
Yeah.
producers,
I've heard of it.
the line was around the corner. Nobody came to see us.
Oh, wow.
So you never know. But I will say it has been the most fun I've ever had losing money.
So what was
Because I got invited to opening nights.
Yeah.
You know,
What was the name of this show you're talking about that opened the same night as producers?
Bells Are Ringing, a revival of a 1950s show.
Gotcha.
So
Okay. So
it was fun because in that show, I happened to be invited to the audition in New York on Times Square, the audition house, where you had actors flying in from around the country to audition.
oh,
And every one of them was better than the other. And I
Right.
couldn't understand why they didn't pick somebody because they were great. The talent was fabulous. So I had a good time.
you had a good time. You got
But I lost a fortune.
yeah, you got to go to the auditions for the whole show.
So that's my fun investment.
How many Broadway shows have you invested?
I have invested in 19.
19.
Two winners, 16 losers, one broke even. And right now I just committed to invest in 3 more. Not Broadway yet, but coming to Broadway.
2 of 19 were winners.
Yeah.
Were they big winners enough to make up for the other 17?
No, I'm still far behind.
You're still far behind.
But that's okay. It's play money.
It's
And
play
again,
money. It's
you
fun.
have to assess the risk and what you can afford to lose.
Right.
If you
Hey.
don't mind losing it, then go for it.
If you were buying limited partnerships in 1985 at $3,000 when they were worth $4,500, and you were doing that for 45 years, you can lose money on Broadway shows all you want.
We were very successful
Yeah.
because nobody else was doing it.
No one else.
But I have
did
to
that.
tell you, when we started doing this in the 80s, we really had no idea what we're doing.
Right.
We really had no idea if the value was real
Right.
because things can change. It's out of my control.
Right.
But we had a turning point, a tipping point in 1998. This is interesting. There was a class action lawsuit against every brokerage house in the country.
Mm-hmm.
Again, Merrill Lynch, Morgan Stanley, Dean Witter, Payne Whipper, Prudential,
Right.
Smith Barney. The class action lawsuit because people felt they were sold limited partnership interest without the proper due diligence.
Mm-hmm.
And all of these brokerage houses settled.
Mm.
And they started sending money out to all the investors. And we were on the list as investors,
Mm-hmm.
even though we never lost money
Right.
because we bought it cheap.
Right.
They still paid us.
Barry and I, we've known each other. Let's see. We've known each other probably going on, well, gosh, it's been 15 years, roughly, since you first got involved in Capstone. And I met you.
I first met you when you had hair.
Yeah, when I had hair. So one of my favorite networking events I was invited to was a Jewish Federation breakfast where you and Ira Gaines were speaking about, you just kind of telling your story. And I remember one of the things that you mentioned in that breakfast presentation, you guys were just sitting at the front room, just talking, just rapping to the whole crowd. It wasn't hundreds or thousands of people there. There was probably 30 people here. And we were in this conference room and you guys were talking about how, just like you just said, you just started buying these LPs and then one day you went to the mailbox and there was a big check in there and your world changed.
That is right.
Can you go over that little story for us again here so the viewers can kind of hear that story?
Okay. First of all, we were buying all these partnerships, which was capital intensive, and we had no money. So that's the first thing. We had to figure out a way in order to pay this because we were buying it from the brokerage companies and they didn't want to have debt. They wanted us to pay for this.
Yeah. Oh, I didn't remember this.
There was one instance where I had 40 charge cards,
Oh, wow.
taking advances and moving the money around from one charge card to the other in order to pay for this. And then we started accumulating little pieces, like 5 units of one, $5,000, another 5. When we got to a $100,000 block of par, of original investment, we sold it back to the broker who sold it originally. The broker who sold a $5,000 investment
Yeah.
thought he found heaven when he can buy it back for $4,200 and sell it to the same clients.
Oh, yeah.
So he thought this was great.
And you're buying it at 3.
And we were buying it at 3.
Right.
it was a struggle for many years.
Yeah, because you weren't holding on to these things. You were packaging up $100,000 at a time, then selling it
We
back.
couldn't hold on because we didn't have the money.
The money, yeah.
Today, I wish we did hold on
Cool.
because many of them really worked out well. But it was fine.
Yeah.
We kept moving the money around, but we accumulated a lot of limited partnerships. For those who do know what K1s are and how complicated they are, back in the early 2000s, my partner and I had together 6,000 K1s that came in 1 year.
Wow.
6,000. We had to hire people to do spreadsheets to put all the information in.
Mm-hmm.
It was mind-boggling. So it got to be really a big project. Then I said, we got all this money from the class action lawsuits, and one general partner who controlled 10 different partnerships came to us and said, we want to buy all of your interest in those partnerships.
Right.
And that turned out to be a multi-million-dollar deal. That was the first one that it actually paid off, and it actually validated that what we were doing was correct.
Right. And this was
This is
1999.
1998.
1998.
Yeah.
Wow.
That's when things changed.
So you're grinding.
That's when I started investing in mortgages.
Yeah. So you're grinding for 13 years. If you started in 1985.
Totally.
Wow.
So a little story.
Yeah.
I was hiking in Oak Creek Canyon. My wife tripped. When we got back to the trailhead, she realized that the diamond in her ring was gone.
Mm-hmm.
We went back to look for it in the stream.
Oh, wow.
Not there. Couldn't find it.
No.
Put the insurance claim in. Went and bought some partnerships. Get the money. It wasn't until 20 years later when she got a new diamond.
20 years later, that partnership's finally liquid.
Well,
liquid.
That's saying. So everything we had was going into this business.
Yeah. Wow. Committed. 110% committed.
But scary.
Yeah.
Scary.
Yeah.
Again, a lot of risk.
Right.
You have to, and if you're worried about raising your kids and paying your mortgage, you can't take the risk.
So you mentioned that's when you started doing private mortgages. So what are some of the things you look at when you're evaluating alternative investments that are on the private mortgage side, or things like Capstone Fund 5 or other similar
My
ones?
history is I invested in mortgages on a one basis.
Yeah.
Individual
deeds of
I never
trust.
went into a fund. I always went in individual deeds of trust, so I could monitor it. I could look at the property. I knew what was going on.
Right.
That gets overwhelming.
Yes.
When I found Capstone 5 Fund, I said, wow, it's diversified, lots of product, things are moving in and out. So there's always a way to get out of something,
Right.
which is very helpful.
Yeah.
But I have a long history. I mean, I've been
Sure.
making mortgages now 25 years. I've had a very big portfolio of mortgages.
Mm-hmm.
I love the fact that I could put pins on the map and look at all the properties that I invested in.
Yeah.
There's no room on the map anymore. But I realize now that it is too tough to do my own underwriting,
It can wear you out.
and it wears me out, and I get worried. So I don't need that.
You're in Capstone Fund 5. Heck, you've been in Capstone Fund 5 for years. How many other similar funds are you in, or how different do you find Capstone Fund 5 versus some of our competitors, or other opportunities you have to go into?
Capstone 5 is probably the most diversified in product.
Gotcha. Okay.
In all the houses you have, different types, different states, all over the place. That's really helpful in softening any risk in any region.
Yeah.
I'm in I deal with 5 other mortgage brokers.
Uh-huh.
Some of them are individual
Individual
mortgages,
loans. Yeah.
and some of them are funds.
Yeah.
So, I have a good wealth of knowledge of how everything works. Some work, some don't.
Yeah. You said you deal with 5 other brokers. In the other 1 or 2 funds you're with, are they leveraged funds, or are they all non-leveraged like Capstone Fund 5?
Non-leveraged.
They're all non. So you only do non-leveraged funds.
It's not true. One of them just started to be leveraged.
Gotcha.
It makes me nervous.
Yeah. Explain to our viewers a little bit about, like, why is it that non-leveraged funds are your favorite, and how leveraged funds kind of make you nervous, and why you favor funds like Capstone Fund 5 that are non-leveraged, 100% private.
When you have leveraged, you have interest to pay.
Yeah.
That interest comes out of the interest income coming in. If we have a period where we don't have where the loan portfolio is lower, that means we're going to get less interest income because that interest expense stays the same.
Right.
Interest income and having a loan, having leverage, is an albatross.
Yeah.
you always have to make sure you can cover it.
Right.
I don't like that pressure.
Right. What happens if loans are going to default, or let's say there's a mini black swan event or a black swan event, and you're in a leveraged fund and the fund is forced to liquidate some properties.
That's happened.
Yeah. Can you give me an example of something like that that's happened in your career?
These are mortgages.
Yeah.
So they were forced to sell the mortgages
Yeah.
to others at a slight discount. Not that bad, but they still had to lessen their portfolio to pay down the leverage.
Right.
That's a concern.
Mm-hmm.
Listen, having leverage gives you a higher rate of return.
Sure.
That's always the case. It always looks attractive.
Sure.
Until the bad stuff happens.
Right. Right. Until the bad stuff happens. Yeah. I get nervous about having leverage because I always want to make sure that Fund 5 is in first position. We never are subordinating to a line of credit or we're never subordinating to our leverage, right? To our credit providers. So that's one of the things we focused on. Have you ever been in a fund that's been leveraged, that there's been a little bit of a panic, or there's been any kind of call from the credit facility in that fund, or have you heard of this before?
Well, people who might live in the Phoenix area might recall Mortgages Limited.
Yeah.
That was a large mortgage fund.
Right.
That went under dramatically. So that, those disasters, that's the one big disaster in this community.
Right.
Where hundreds of millions of dollars were lost.
What do you think would happen to that fund if they were not leveraged? If they were 100% private and not leveraged, how do you think that would have played out?
Weather the storm.
They think they could have weathered it.
Absolutely.
Yeah.
They wouldn't be able to pay back their investors right away, but they could have worked out the situation, gotten rid of some bad loans, keep the good ones, and still continue.
Yeah. Ridden out the storm, 10 years later, they probably would have been all right. Yeah.
Some length of time. Absolutely.
Yeah. Somewhere. Yeah. We've talked about a lot of things today. So if someone is looking at alternative investments, and let's just say they're in a traditional portfolio, they have a financial advisor type person, they're in a typical modern portfolio that's 60% stock, 40% bonds, or something similar like this. If you're talking to someone about alternative investments, how much would you tell someone, hey, if you have a portfolio you're working with, what would you think would be a good amount or a good allocation to have in some type of alternative investment?
20%.
20%.
Yeah.
Gotcha.
Now, to add to that, I'm totally in disfavor with alternative investments being in retirement accounts. Because retirement accounts are there for retirement. They're there to be safe.
Mm-hmm.
There to give you a comfort. And that's where you get into the risk analysis.
Gotcha.
If you're in an alternative investment, there's some more risk than mainstream investments.
Right.
You have to be careful with that.
Gotcha. If we're talking about real estate as an alternative investment, would that be a different story in a retirement account?
Probably is.
Yeah.
Again, I've always been in favor of real estate being part of retirement accounts.
Right.
That's not really alternative anymore.
Right. And you said you said that you didn't even, earlier we were talking before the show, and you mentioned that you didn't even consider Capstone Fund 5 to be an alternative investment.
No, not really.
And why would you say that?
Liquidity.
Right. Because we do have liquidity.
And a lower amount of risk. There is risk on foreclosures.
Sure.
And we who have gone through the recession back in 2007, 2008, and saw the values come down below our underwriting.
Right.
That was a disaster. But if you had time to work it through, everything came back.
Right.
So even with Capstone 5, even with all the product you have, it's very unlikely that everything would go below underwriting.
Right.
Below the loan.
Below our loan amount, that's going to be 65% of value.
Right. And again, not having leverage, even if it goes below the loan, you have some product and you can work it out. It's a matter of time.
Yeah, we can.
Real estate.
We can own the property and
real estate, houses, they just go up with inflation.
Yeah.
So you can work that out and you can come out okay.
Right. Yeah.
So I don't consider that really a risky alternative.
Gotcha. So what we're talking about today with you, alternative investments being higher risk things that you might
higher risk, less liquidity.
Little liquidity, yeah. Not appropriate for retirement accounts.
That's what I feel.
Right.
Even though I'm pretty heavy in alternative investments in my pension plan, but
Yeah.
it depends on how much risk you want to take.
Right.
I'm going to give you a story.
All right.
So here we were, having done these limited partnerships, buying on a secondary market, and the exit was either they sell the property,
Right.
pay us off, or they become public. A
Mhm.
lot of these limited partnerships became public on the New York Stock Exchange because the general partners want to keep the management fees.
Ah.
So my partner and I looked at each other one morning and said, the same investors who know nothing about the investment that sold to us as a limited partnership now own this stock, this New York Stock Exchange stock, and they know nothing about the investment. Why don't we tender it at below the stock price?
Uh-huh.
So we did an experiment. The first one was selling for $12 a share on the New York Stock Exchange. You can't get more liquid than that.
Right.
We went out to do a tender offer on those shares at $10.
Mm-hmm.
Nobody in history has ever done a tender below market. It's always been premium.
Gotcha.
We just did it as an experiment.
Right.
Didn't cost us anything. And we got in 40,000 shares.
Wow. Didn't cost you anything but the cost of a
30
stamp.
days made $80,000.
Wow.
Going, what? Who's selling to us? This is insane. And we had no idea who was selling us the stock. Well, we went ahead and did a lot more of those for 18 months. And we wound up getting a lot of response, which we had no clue why that was. And the end of the story, we found out that trust officers in banks would come into the office, open their computer, and see, oh, Tootsie Roll stock selling. There's a tender offer for it. Their mind said it must be a premium because that's what always was done in the past.
Ah.
They didn't realize that they were selling it at a discount until they got the money. And they called me and said, we would like our stock returned. I had some choice words, but this happened repeatedly from trust departments of major banks. We're talking about employees who come in and had no clue of what they're doing.
Right. And not at the time, not looking at the Wall Street Journal of the day to check the stock price.
Well, the stock price is on the machine, but they didn't check it when they sold it.
Right.
They just said, oh, there's a tender, and they press the buttons. Their clients have 40,000 shares, and here it is, and they sold it to us.
Yeah. Wow.
It was wild.
That is wild. Don't trust the banks.
Totally agree. Don't trust the bank, trust departments.
Yeah. Barry, give me one example or one story about something you learned in your career early that's just stuck with you up until this day.
One of the things we did is we made a tender offer for some bonds. The bonds were selling for $700. We made a tender offer at $550. And then State Street Bank and Trust out of Boston, very revered institution, came to us and said, we want to sell you for our client 10,000 bonds at $550 each. We had offered to buy 2,000. They came back and said 10,000. My first instinct was, what did we do wrong?
Right.
I spent an all-nighter looking at every indenture, every financial statement, every news clipping to see if there's a red flag of why this bank is selling us the bonds at a discount.
Right.
So the answer to the question is, go with your instinct, go with your knowledge. Don't rely on others to dictate where you might want to be.
Right.
We went ahead with the deal. And I will tell you the end of the story. After being sued in federal court in New York, they wanted their money back. They wanted their bonds back. The end of the story was the client was a Canadian company that owned the bonds.
Yeah.
And some little clerk made a mistake on the conversion table between Canadian dollars and US dollars. They had it backwards. They thought they were selling it for a profit when they sold it for a loss.
Yeah.
That's simple. But they answered the question about what I've learned is, stick to your guns if you think you know what you're doing.
Barry, of all the stuff we've talked about, what advice would you give to somebody who's really looking at alternate investments for the very first time?
I receive a lot of investment opportunities all the time. I've earned it over the years. But in the beginning, you are sold an opportunity from somebody who's not putting their own money in.
Mm-hmm.
My advice is, it's your money. You call the shots. Don't be swayed by the salesman. Take a look to see if it's not that it's real, but it really could work. It's in a good location or it's a good asset. You have to determine that on your own with your own sense of intelligence and not depend on others.
So really, in all this alternate investment talk and all these alts that we refer to, really how has alternate investing really benefited you?
Alternative investing is just one means of making money, but it's not just about the money.
Gotcha.
You want to have fun.
Yeah.
This is something different. And it's wonderful at dinner parties to talk about an alternative investment rather than saying, I just bought Tesla stock.
Yeah.
You know, when you can say something different, it really gets everyone's head up.
Like I made money on 2 of 19 Broadway investments.
So I was on a cruise and I was speaking about what I do about investing.
Yeah.
People were dozing off.
Really?
I said, I invest in Broadway shows. Every table around us came around me. They all wanted to know.
Right.
It became a fun event.
Right.
And here I was with the most risky investment, but it became fun.
Right. It became fun. Yeah.
So,
What's the smartest investment you've ever made?
the smartest investment was buying into a private partnership that owned the Anheuser-Busch building in St. Louis. And it was 25 years after the partnership started, and we were dealing with the beneficiaries. And the vote had to be taken whether to sell the building to Anheuser-Busch at a very low price.
Mhm.
And I proactively went and called all the other investors, the barber, all the people who were still alive,
Yeah.
the old guys who all had a share of this through August Bush.
Yeah.
And it was so much fun. And that was and then we got the price up.
Ah.
I convinced Merrill Lynch, the general partner, that they shouldn't just accept the price. They need to raise it, which they did. And Anheuser-Busch said, fine, let's do it.
Yeah.
So that was very rewarding.
Yeah.
And I met a lot of people.
It almost sounds like calling out people and meeting all the people is almost a better payoff on that investment than the dollars.
It was just an enlightening, more fun experience than just dealing with money.
Yeah. Yeah. What is the dumbest investment you have ever made?
Dumbest investment was agreeing to go into the Mortgages Limited Fund
Ah.
rather than buying single deeds of trust, which I used to do because I used to see what I was buying.
Right.
So it was a bad move.
The Mortgages Limited leveraged fund.
Right.
Leveraged. Yeah.
Yeah. For those who don't know, it imploded. The owner committed suicide, left everybody hanging for years. We're now in probably year 15 and it's not resolved yet.
Oh, wow.
There's 2 properties left out of the fund.
2 properties up here in Phoenix. Or they had some stuff down in Tucson too, right?
In Phoenix.
In Phoenix, yeah. Gotcha. All right. Well, talking about resolving real estate, why don't you give us what is your take from your perspective on what's going to happen in the real estate market this coming year? Hot take. Real estate, hot take in the next 12 months.
Up.
Yes.
I think there's a need. And again, there's various segments of real estate.
Sure.
Housing, multifamily apartments have suffered greatly. They will come back as interest rates are going to drop.
Yep.
Industrial right now is oversaturated, but there's still a need for smaller spaces from a lot of manufacturers that use them. Retail, stable.
Yep.
We all thought retail was going to be dead after COVID, but it's come back. And then office buildings, everyone thought they were dead, but there's still life in the good ones. So I think totally the real estate market will rebound a little.
This coming year. That's good news for us. We have a few houses to sell here at Capstone.
Yeah.
Yeah.
And if interest rates come down and people can afford the mortgage,
Yeah. Just have to be
then
patient.
it works.
Yeah.
And that's going to happen.
Great. Well, Barry, thanks for coming on the show. As we talked about, this is one of the first episodes. We just started this podcast, so I appreciate you coming on and giving some tidbits to our viewers and looking for the next time we can get you.
And if you're in alternative investments, you don't have to wear a tie.
You don't have to wear a tie.
Right.
That's right. Exactly. You only wear a tie if you're on Wall Street in the traditional investment world, for sure. Exactly.
Good.
All right, perfect. Thank you. All right.
Right.